Hello my fellow freedom builders and welcome back to the channel. Today's short video is about the Fear and Greed index and if we can use it for anything and if it is about to show us that the market will turn. Now I have been predicting, maybe predicting is not the right word, but I have been suspicious for some weeks that the market was about to turn. I have several things I'm looking at, but one of them is one of the ingredients in the Fear and Greed index. If you don't know the Fear and Greed index, I made some videos about that before, but what it basically is a measurement of 7 different indicators. It is something about the market momentum, meaning the S&P 500 and its distance towards the 125 days moving average. It is stock price strength. It is McClellan volume summation index, also a bit of a technical term there, but I might go into some of these later. But this is a collection of a number of different indicators. Now the one I am going to have a look at today is something called the put-call ratio. And what is a put-call ratio? Well, if you've seen my videos about options, you know that a put option and a call options, they are 2 different ways of using options in the market. If you buy a call option, you think that the market is going to go up and therefore your call options are increasing in value. And yeah, in a bull market, most people buy call options. When you're buying a put options, it's more like an insurance. So you can insure yourself from your stocks going down, meaning that if you have a portfolio and you think the market is going down or your specific stocks are going down, you can buy a put option, meaning that you buy the right to sell your stocks at a given price. If your stock costs $100 and you don't want to lose any more than $5 on it, you can buy a put option at $95 at an expiration date some month out in time. You pay a bit of premium for it, but you are guaranteed you can get rid of your stocks at 95 if it should drop. That means that when we see the number of put option bought in the market, when we see that go up, it means that people are getting more nervous. When we see that the number of put options go down, at least compared to the call options, we see that more people get more bullish. So what can we learn from the put-call ratio? Well, when it is very high, and of course that can vary, but I normally say something around the 0.05 to 0.1 here, that is fairly high. I should say this is the 5-day average put-call ratio because the actual put-call ratio looks very jagged. This is a bit of a better picture in my opinion. So when this is somewhere above 1.05, 1.10 or above, it is extremely high. When it goes down below the 0.8, 0.75, something like that, it is getting low. How can we interpret that? Well, here we can only see something like a year back in time. But what we can see is that when the put-call ratio is very high, it means that people are buying a lot of put options compared to call options. That means they're nervous. And when the market gets too nervous, when they get over nervous, it actually means that the market is about to turn. On the other hand, when the put-call ratio drops, it means that almost no one are buying put options, or at least a lot fewer people are buying put options, meaning that the market is a bit overconfident. They don't think there is a reason to buy insurance, and they are only betting on long. And when enough people are betting on long, it's normally a good sign that all the quote-unquote dumb money are entering the market, and the clever people are about to make the market turn around. Again, it cycles up towards the very high put-call ratio. Then we have a bit of a mixed area here over April, May, into June. But when we get into June, we get down to this level again, indicating that the put-call ratio is low and therefore the market might actually be going down because no one is believing they should buy insurance, which is normally a good time to do it. It gets actually very low. This is not 0. This, for some reason, they're only running this down to, I don't know, 0.65, something like that. But this is extremely low, and this is an indication that the market should probably go down for a while. Then we get to a very high level of put call. People are too worried, meaning that the market could go up. And right now we are in a level at 0.75, meaning that we are about to reach a level where the market could go down. Now, this is just my claims, but I have put these extremes on a map, or on a graph. I'll show you just in a second. And I have not picked the exact extremes because we don't know when it will turn around. So I have put the time where we start to reach a level where I normally get a bit nervous or hopeful that the market will turn around. So let's have a look at the S&P 500. This is a weekly time frame. And these arrows here are the places where the market either the put-call ratio either indicated that the market might be a bit overstretched to the upside, which was back in November 22. Then it went down, and the put-call ratio indicated here at the end of December that it might be a bit overstretched to the downside. Then it turned around, be overstretched to the upside, turn around, overstretched to the downside, turn around, and then we got this a bit muddy period where we couldn't really see anything. We got an up signal here, and then we didn't really get anything until we got to some times in the start of June. Now here, it still kept moving up. It was not like this is a perfect indicator, although it could seem so from these. So it actually still made its way up something like 3% from here. But when we reach these levels where we have extremes in the put-call ratio, we are often close to the top or the bottom. So when we got to the area here in October, it signaled, all right, now it might be time to go up. But it didn't. October was a terrible month. And then we got up, and the market actually got, imagine yourself a rubber band. The nature of the market signaled that we should go up here, but they just pulled the rubber band further and further, and then it exploded upwards. And now we are at a time looking at this 5-day average put-call ratio where we are down at 0.75, meaning that no one is buying put options. Of course, there are some, but compared to earlier on, then there are a lot less people buying put options. People think they can walk on water, nothing can go wrong, the market can only continue upwards. They're talking about Christmas rally and window shopping and all that stuff. But what the put-call ratio is indicating is, and actually has been for some weeks, that we are, if not at the top, then very, very close to the top. Now, today or this week, we're actually seeing that we are down so far something like 0.9%. The equal weighted index is not as much down, but that is another story. So what I will be looking for is that if the S&P 500 moves its way down to something like the 45, 20, 30-ish, there will be another factor setting in, something called the gamma exposure and momentum dragging one or the other way on the S&P 500. And that is also an entirely other story, but is a very powerful thing in the market that can start pull the market down. But right now, just looking at the put-call ratio, it indicates the market doesn't have too much upside in it, and I suspect that we will see some sort of retracement over the next weeks. Now, I'm not talking about a crash. No one knows when a crash will come. So I'm talking maybe 3 or 5, maybe 7%, who knows. It could also be a larger move down, but I have absolutely no knowledge about that. No one has. So what I'm expecting over the next weeks is some sort of retracement in price. And let's see if it happens. As I said, it can go up. The put-call ratio just indicates that it is not as likely, there's not as much upside potential in the market right now as there were down here. So look it up. You can just Google Fear and Greed Index, and someone likes to look at the Fear and Greed Index itself. There is this the scale here, and you can also look at it as a timeline where you can see where it has been at different stages. But the one I'm looking more at is the 5-day average put-call ratio here. I think that tells us a lot. That's all for now. Take care of yourself and your money out there. Remember to subscribe, and I'll talk to you again shortly. Bye.